All right, so let's talk about the Swan defined risk strategy. My last video, when I got cut off for some reason, not sure what that was about. So now I'm part two of this. So if you haven't seen the first part of this, go back. I'll put a link up there, and then you can click on that to watch the first part, because the first part shows you some of the benefits of the Swan defined risk strategy, not specific to Swan, but specific to actually hedging a portfolio to protect against a downside risk. Now, the negatives of this, I'll tell you, are a couple. First and foremost, anytime you're doing a hedge strategy, and I'll give you Swan specifically, it's in an IRA or an ERISA plan. ERISA is the Employee Retirement Income Security Act from 1974, 401ks, NACO, 403bs, and those kind of plans. There are some limitations, all right? IRAs, DOL, Department of Labor regulates those. A taxable mutual fund or brokerage account or investment account is regulated by the SEC, essentially. So the DOL has more authority than the SEC. And so essentially, I don't want to say more Wild West, but the less regulated, and I hate to even say that because it's still heavily regulated. But at a taxable account, there's just more ways that a hedging strategy can work when it comes to option trading. There's just no two ways around that. So if you look at the Swan defined risk strategy, and you look at it in the IRA context versus the taxable old-fashioned brokerage investment account, the investment account just is going to swamp it. At least it has historically, and I don't know if that will continue going forward. But I asked them, I said, why? Why are the differences between the two? And inside an IRA, the Swan did not do as well relative to outside the IRA. And I remember asking one of the PMs, portfolio managers, and they said, it wasn't Randy or his brother Swan, is some guy who works for him. They said simply because the IRA has more limits on what we can do in terms of the hedging techniques we use. I think what they say is they have to use a certain amount of index options as opposed in a taxable account. They can get real specific. I can't remember exactly. I think they could do real estate hedging strategies outside an IRA. And in the IRA, they can only use index strategies, which was fine, but it wasn't quite the same context of a non-IRA hedging strategy, not anywhere close. All right, so that's part one. So you got to remember IRA versus non-IRA. Ideally, one outside an IRA. I have no clue what the tax consequences are, my friends. I just don't know. So that'd be something you have to consider right there. Number two is I want to share with you. So Swan has, they have this separately managed account, and this is where it comes to paying a guy to run your money. All right, so if you're paying for an investment advisor, well, doggone, get him to be an investment advisor to actively manage the portfolio on a daily or weekly or quarterly, however they're doing it, where they're actually placing trades, they're actually researching, they're doing their technical analysis, they're doing the hedging, whatever. If you're going to pay somebody to do it, well, they should be doing that. I don't understand this. I'm paying somebody to do a bunch of index funds. That doesn't make any sense to me. You can do that and save the money. My goodness, just go to Vanguard. Say, Vanguard, if you want to pay somebody, just go to Vanguard. They'll charge you 30 pips. It's less than 1/3 of 1%. And you'll actually be better off than hiring some guy and some registered investment advisor to do the same thing. It's mind-boggling that people do this. And so what happened, what I'm getting at is here, if you're going to hire an investment manager, you want it in what's called a separately managed account, an SMA. If you can get that. Now, SMAs, they don't take a $5,000 IRA. I'm just telling you. Usually it's going to be, 100, usually 250,000 or more to get involved. I think Swan is 250, maybe even 500. I think it's 250. But what they're doing is they're literally taking your money, and they're not what's the consolidating with all these other people where they're saying Josh's money, Charlotte's money, Timmy's money, blah, blah, blah. We're putting all together in one mass account. They're literally using it to, each and every account is its own unique account in theory. But still, I think there's some validity to that. And so what happens is it's being traded as if it's your specific money. Well, because it is. A mutual fund, everything's being consolidated into one. It's commingled, essentially. And that's not what we want. A separately managed account is not commingled. You actually own the shares. You actually own the holdings. The trades are actually made in your account. And that way it's a little bit more expensive for sure. But if you're paying somebody to do it, well, again, have them do it as they do it right. Not where they're doing it commingling with all these other people in some basic asset allocated account where they're just doing push button trading warfare. That don't make any sense. So don't do that. But if you're going to do an SMA, so anyway, so Swan says, I'm sure they did this because Berkshire Hathaway, they offered A shares and they offered B shares because it seemed very exclusive because the price of Berkshire Hathaway got over 6 figures. And they said, well, we got to offer B shares or else we're exclusive and blah, blah, blah. And I'm sure Swan and a lot of SMAs do the same thing. where they offer their own mutual funds as opposed to the SMA. And a mutual fund is commingling of accounts, and you can get in with a minimum at $5,000, whatever it is. I don't know, $3,000 typically. And that's not necessarily what we're shooting for. And I'll share with you why here in just a second. But first, let me give an example of history for me. My mom used to be very interested in the markets, always got me interested in the markets. She had this big, thick thing called Value Line. I don't know if she had a subscription or if she just got from the library, but this huge book was a Value Line where you could look stock by stock. So you're going through your charts, stock by stock. It was fun. If you like statistics and like analysis, just like baseball stats, and you'd love Value. I'm just telling you, it's awesome. And Value Line had a newsletter where their picks, and they just smoked the market, their Value Line newsletter. And I guess at some point they were told, you might as well make some money off this and do a mutual fund. And they did a mutual fund, and it sucked. It was horrible. It just did horribly relative to their own stock picks. I don't know why, the mechanics of it, the expenses that go on. I had no idea. I remember like 15 years ago, maybe 20 years ago, someone did an article on it. I don't know, Bloomberg, Wall Street Journal. I'm not sure. They said, why can't Value Line's mutual funds do like the Value Line newsletter? And I can't remember what the reasoning for that was, but it was night and day. The Value Line stock picks did this. The Value Line investment from the investment newsletter did this. The Value Line mutual fund did that. It wasn't close. It was not even close. I'll never forget that. And again, there's something that happens when you commingle funds with others, when you have all the rigmarole of a prospectus of a 10, I forgot what the thing's 10K. I can't remember what the mutual fund statement of annual additional information, all this stuff, the regulatory environment. You still got to have money coming in, money going out. There's something that happens that makes it less efficient. And same thing is going to happen with Swan here. So they offer their own mutual funds. So you can see if you go to Swan, you go up here to strategy. And this is going to be the defined risk funds. All right. So Swan defined risk funds, not the defined risk strategy. This is defined risk funds. You go down here, and they always say, and you see Swan Defined Risk Fund, Defined Risk Emerging Markets Fund, Defined Risk Small Cap Fund, and Defined Risk Foreign Developed Markets. So let's just look at the one-page brochure here of the Swan Defined Risk. I think this will be the fund, not the fun. Let's see what we got here. So let's bring this up a little bit. And again, this is not a solicitation. Don't buy this off me. I'm not telling you to buy this thing. I have no clue if it's right for you. That's up to you. I have no idea. I'm just showing you a different perspective of downside risk mitigation other than stupid asset allocation where, we have non-correlated assets, so we're going to be safe against the down market. Bonds go down, stocks go up. Don't get me started. All right, so let's see what we have here. Let's see if it talks about the portfolio, and we can read all this. Max drawdown. All right, so you see, this is the problem here. This fund came out in 2012, but they're showing largest. They're showing. Okay, so I'm not going to read all this verbatim here. You're gonna have to read it yourself. But it doesn't tell us much about the fund's performance since 2002 when they ran it. Growth of a $10,000 hypothetical investment, 1968 to 2017. Buy and hold was up 1.2 million. If you miss the 10 best quarters, you only had 232,000. If you missed the 10 worst quarters, you had 8.3 million. If you missed the best and worst quarters, you had 1.5 million. I mean, okay, that's fine, but it's okay. It doesn't really tell us much there. So I want to go to the Yahoo Finance thing. That page didn't really give us much. And I just want to share with you, the performance of the Swan Defined Risk going back to inception, which is in 2012. It wasn't much. And now they got 2.75 billion. So it's pretty, it's got a big asset base for sure, but it costs 1.16. I got no problem with that. My goodness, if they're actively doing active portfolio manager, I have no problem if they're getting a fee. Categories option based. So if you're looking at Swan or like-minded categories, that's what you want, or funds, an option based. So they're hedging essentially. They're hedging, they're buying puts, selling calls. I literally don't know what they're doing, but that's what they're doing. They're hedging strategies so that way the market goes down, they can put something to you at a lower price. But anyway, so let's see so far this year, they're down 4.15%. Which is pretty significant because in 2008, they're only down 4.5%. All right. So this year hasn't been drastic, and yet they're still down 4.15%. This is as of October, I believe. And then I want to look at, let's go to the chart. We're going to compare it to the total stock market index fund. If we can get this to cooperate. Yeah, here we go. All right. So what we're going to do is we're going to compare the Swan defined risk, and we'll just do 5 years. And we're going to compare it to VTSMX, was the total stock market index. Actually, let's just compare it to the S&P 500. There we go. That'd be fine. All right. So we're going to compare the Swan defined risk to the S&P 500, and we shall see. So here's the S&P 500 is up 43.89% since inception. Here's Swan was at 10.45%. So Swan has got about a quarter of the return of the S&P 500. Historically, Swan gets about 40 to 50%. So we haven't seen that since inception. But again, since 2012, it's been an up market. Let's just do the last 3 months, though. Oh, there's the total stock index populated for me. All right, so let's just do the last 3 months here. Well, I guess it's going to give me a hard time. There we go. So the last 3 months. So, here's where this is supposed to make it rain. When the market is going down, a hedge fund is supposed to give you downside risk protection, and we simply aren't seeing it. Here's Swan right here is down. What's that? 6.2. Yeah, it's 6.2. S&P 500 is down 7.8, and then the total stock index is down 9.8. So Swan's supposed to give you historically roughly 45 to 50% of the upside of the market. So the market's up 100, you're getting 45. Market's down 100, you're only going down 22. We're not seeing that at all in the last since the mutual fund came into existence. Giving us about 25% of the up and about 80% or so, 90% of the down. And again, this is just one sample, but look at that. That's the big down right there. And you can see that's what date is that on October 9th, 2018. I mean, you see pretty significant drops across the board between the Swan and the S&P 500 and the total stock index. So you got a couple things going on here. When you have mutual funds, something happens in a mutual fund where the strategy is mitigated to some degree. I don't know what it is, but I'm telling you, with the Swan fund, with the Value Line fund, there's just tons of funds out there. People back test their investment philosophies, and then when they put them to actual practice, it doesn't work the way anticipated. Something happens. I don't know what it is. Expenses, I think, but I don't know. Secondly, you got to watch out in an IRA. If you're going to have a separately managed account, it's option based. You just got to remember there are things they can't do in an IRA that they can do in a taxable account as well. So lastly on that, this has nothing to do with Swan, but if you're going to hire somebody to manage your money, make sure they're actively managing your account. That doesn't mean it has to be a lot of trades, but man alive, you want individual holdings. You don't want a bunch of mutual funds. You want individual holdings. If they have individual holdings, I'm fine with them actively manage your account if they're actively managed with individual holdings. If they have just a bunch of ETFs and mutual funds, that's not actively managed. That's turnover management to the other guys where they're just allocating, and that's not active management. So don't pay for it. All right. So I hope this helps. Again, this is the Swan defined risk strategy. I'm a fan of it for sure for the right person. I don't know if you should be. No idea. I'm not holding me accountable. I'm not recommending it in the least. That's up to you. What I am saying, if you're looking for downside risk protection, asset allocation is not nearly enough. You need to one of three things. You don't go in the market, you buy CDs or government bonds, or you buy a hedge strategy. Those are how you avoid as much as you can downside risk to some degree. But just because that's happened in the past certainly does not mean it's going to happen in the future. You can certainly lose all your money. So just keep that in mind. As always, don't forget to subscribe down below. Thumbs up always help. Comments, love to hear suggestions for other videos. And again, go to the blog at heritagewealthplanning.com, and we'll see you next time. Thanks, guys.